Welcome, it's denome. In this video, you'll learn what is impermanent loss, should you be scared about it, how much money you can actually lose from impermanent loss. Many people ask about this all the time from me, so I just wanted to make a video to explain exactly what it means in simple terms. So I have the perfect example here because I lost a bunch of money because of impermanent loss just recently. So I covered this token called Auto token, which is part of the Auto Farm ecosystem, when it was about $400 in the early February. And from there, the price of Auto went on a complete tear and it peaked at about $13,000. So the gain was about 30x on my capital had I just bought Auto tokens at the time and just held it in my wallet. But because I was providing liquidity on the Auto to BNB liquidity pool and I was in a yield farm, I actually did not get that 30x return on my capital. I only got about 1/3 of that. So I lost about 2/3 of my capital to impermanent loss from this upside that happened here. So instead of me getting that 30x return on the capital that I had in Auto, I only got about 10x return on my capital on the way up. So you lose money on the way up, but you also lose money on the way down. So had I removed my liquidity on the top here when it was about $13,000, I would have not suffered as much losses on the way down. So as you can see, the price of Auto is down by about 70.8%, but I'm down about 16% more because I'm providing liquidity because of that impermanent loss and how it works. So how does it exactly work and what causes this impermanent loss? Impermanent loss is caused by these automated market makers or decentralized exchanges that use liquidity pools to provide the price and to provide liquidity on that exchange. So on pancakeswap, for example, you have different liquidity pool pairs here, and you can provide liquidity here. You can stake the liquidity pool tokens and do some yield farming stuff and so forth. So for example, you have this Auto to BNB pool here. So here you can see that it has Auto tokens and it has BNB tokens in this pool. So the price of one Auto is actually derived from the supply difference between Auto and BNB. So the price is simply the amount of Auto in this pool divided by the BNB in this pool. And as the ratios change, the price of one Auto changes as well. That is causing the price of one Auto to actually move. And from here, you can see that the liquidity pool providers actually earn fees when they provide liquidity on the Auto to BNB pool as well. That is the incentive, the inherent incentive to actually provide liquidity, but there's an additional incentive nowadays with the yield farming as well. But anyway, for example, if you, let's say you had 24 Auto tokens, if you wanted to sell that 24 Auto tokens to BNB, what would happen exactly is that you would actually deposit that 24 Auto tokens into this protocol. So this would have, after you had done your swap, it would have exactly 4,000 Auto tokens, and it would have less BNB tokens because you would get you would extract that BNB from this pool after you did your swap. And that's how these pools work. And arbitragers are constantly trying to balance this equation. If one decentralized exchange has, let's say, a higher price than another one, so arbitragers are constantly trying to balance that to make a little bit profit in between the price differences that happen here all the time. Anyway, that's how automated market makers work. But what is causing this impermanent loss? It is caused by this. So when the price of Auto is going up fast, it means that, let's say you had 20 Auto tokens at the beginning, because people are taking Auto from the liquidity pool and depositing more BNB into that pool. That is causing the price to actually go up. But because you're providing liquidity, your ratio actually changes how much Auto to BNB you have whenever you want to claim your tokens. So you have less Auto token as the price goes up and you have more BNB tokens. So you're basically selling your Auto tokens all the way up here. So it would be more beneficial to just hold your Auto tokens until the peak here and sell every 20 Auto that you have at the same time. But what happens is that you have basically sold about 15 Auto tokens all the way up here, and you have about 5 Auto tokens and a bunch more BNB tokens. But you do not have equivalent amount of BNB than you would have in the lost 15 Auto that you lose from this impermanent loss. So on the way up, you lose Auto tokens, you get more BNB tokens, and on the way down, you are actually basically buying more auto tokens as the price is going lower as well. So you have more auto tokens on the way down here. And that's how the system works with liquidity pools. And there's a perfect examples, really good post that actually explain the whole situation here. And there's a curve here that explains the losses. So if the price of one asset actually doubles compared to the other one, you will lose about 5.7%. And also if the price actually goes down by 50%, you also lose about 5.7% to the impermanent loss. And also if the price goes about up by 5x, then you lose about 25% in impermanent loss. And also if the price of the token goes down by about 80%, that's when you lose about 25% more from this impermanent loss as well. So this image did not explain really simply what this actually means. So for that reason, I actually made my own chart. So this is my own chart that I made to actually explain the same situation. So if the price, let's say you have USDT and Link in the liquidity pool, one USDT is worth $1, and in the beginning one Link is actually worth $1 as well in this example. So you have 100 units of both tokens, so you have a pool value of 200 tokens of both. But now the price of Link actually doubles. Because of this impermanent loss that you sell the Link tokens as the price goes up, you actually have less Link tokens. And from that, when the price of Link doubles, you have about 70 Link tokens, and the total pool value is $283 compared to $300 that you would have if you just had held. You have the original $100 in USDT, plus you have $200 worth of Link in this scenario. So the loss is about 5.7%. There's a more detailed list here that I also did. So you at 2x, you have about 70 Link. At 4x, if the price moves about 4x, you have lost basically half of your Link for this impermanent loss thing. And if the price goes up by 9x, you have lost 2/3 of your Link already. But you have 300 units of USDT, and one Link is worth $9, so you have about $600 worth of capital. But had you just held that Link token, you would have $100 worth of USDT and $900 worth of Link. So 100 units times the price, which is $9, you would have a total value of $1,000. So the impermanent loss is minus 40% in this scenario if the price actually goes 9x. Without calculating all the profits that you can make from the yield farming and from the liquidity providing fees and so forth. So in this chart, you can actually see that as the time goes on, or as the price actually goes up, you lose more and more to the impermanent loss. So at 100x gain, instead of you earning that 100x gain on your capital, you only get about 20x gain on your capital, which is still nice in my opinion, not bad at all, but you still have less than you would have had you just held it. But in the lower amounts, it's not as significant as in these higher amounts here. And the same thing when the price actually goes down, you lose money quite fast as well. So if the price of the token goes down by 75%, had you just held it, you would have 100 units of the USDT as you had originally, and you would have 75% less value in the 100 Link tokens that you have. So you would have 100 tokens plus $25 worth of Link. So you would have $125, but because of impermanent loss, you only have $100 worth of capital. So you have basically lost half of your capital because of this impermanent loss thing here. And that is the dipping point. After that, minus 75%, you actually start losing more than you potentially could even lose if you just held that 100 USDT. So you do not want to hold shit coins on liquidity pool tokens, and you do not want to provide liquidity on shit coins, because when a shit coin plummets or when there's a rug pull, you can lose your BNB from the liquidity pool or Ethereum from the liquidity pool as well, because as the price goes near zero, you will lose that value on the BNB as well. So these losses are basically infinite here that you can lose here. So liquidity pools are very bad. If there's a rug pull, if they mint infinite amount of the token, then you basically lose your BNB value and the shitcoin value. So you lose all the money that you have in these liquidity pools. So that's why it's quite risky here. But if you provide liquidity on a stable asset, then there's not that risk, or shouldn't be that risk. But anyway, it's the same risk on the way down. If you lose half of the value, then the impermanent loss is 5.72%. If you lose 75%, then it's 20%, and so forth. Yeah. So on the way down, you lose. On the way up, you lose. And that's what's happening all the time here. So now, what's to offset this, and why I'm personally not too worried about it? Well, the first thing is that you earn fees from this. So for example, how you can calculate the gain that you get from providing liquidity is you simply get the fees here from this trading pair, which is $34,000. That's the daily fees. And you divide the total liquidity in this pool. So 67,200,000. So this times by 100 to get the percentage. So you earn about 0.05% per day. So if we calculate this on a yearly basis, that's about 18% annual return on your capital by providing liquidity here. So you get about 18% on this trading pair as well. Okay, let's not use auto. Sorry, let's not use auto because there's a better example. Let's use BNB to EGLD pair here, for example. So this, you earn the fees, and it's the same calculation here for the thing. So $5,000 in fees divided by the liquidity, which is about 5 million times 10 times 100. That's about 0.1% per day. And if we times it by the days we have in a year, that's about 36% annual return by providing liquidity with BNB and EGLD pair. But you can also stake those liquidity pool tokens. So if you stake the liquidity pool tokens here, you earn cake tokens, which is about 100% capital on top of that liquidity providing capital that you can get from the fees. You get these cake tokens. But if you actually stake those liquidity pool tokens here on Auto Farm, you actually earn a little bit more, because what you do is this protocol automatically sells all the cake tokens and buys more of the BNB EGLD liquidity pool tokens. So you get compound interest because of that you sell that cake token automatically. Plus you get auto tokens as a third reward. So all in all, these rewards together offset the losses that you would get from that impermanent loss. So I'm okay to provide liquidity on many pairs as long as it's not a shitcoin and I get a high return on my capital by providing the liquidity. So for example, here you can see that I have BNB auto liquidity pool here, and the current value is about $38,000. So what happened here on the peak, and that's by the way on the bottom here about $4,000 here, is that I have the $37,000, but there's a calculator here that you can actually use. And there's many calculators. I will link the best ones that I know of in the description box. But originally on the top, when the price was about $13,000, I had a value here in this pool which was about $70,000. And I had about $35,000 in BNB value and $35,000 in auto value. And because the price actually went down, had I just held both of those assets, the BNB and the auto asset, on its own on my wallet, I would have currently $45,000 worth of capital. But because I'm providing liquidity, I only have $38,000 worth of capital. So I lost about, how much is this? $7,000. Yeah, about $7,000 to impermanent loss on the way down. And that's a huge loss, right? But I also earn the liquidity providing fees and the auto fees while doing this as well. And on the way up, the deposit value that I had was about $8,000 or $8,500 while making the video, and the price of the auto actually went up by about, how much it went up? 3,000%, yeah, 3,000%, while the price of BNB in this scenario went up by about 200%. So let's calculate my impermanent loss there. So it gets into about $80,000. I took some profits on the way up. Impermanent loss was about 43%. So I would have, if I just held it, I would have had $144,000, but it went up to about $70,000 all in all. So I lost about half of my capital because of this impermanent loss thing, had I just held the auto tokens instead of providing liquidity. So all in all, I lost more money by providing liquidity and by getting all the fees and the yield generation and everything. But personally, I rather get certain returns than I can get hoping for the price to go 10x or 20x or 40x or whatever the price is. So I rather get certain daily returns than to hope for a better price. But all in all, if I would have been smart, then I would not have provided liquidity, because I could have doubled my money compared to what I did with providing liquidity and doing all these things. Anyway, this is, you could say, my mistake, but personally, I'm not too worried about this. Again, I get certain yield and I get the auto tokens as a reward. So you can choose if you find this yield farming suitable, but this is definitely risky. And also, if you are worried about taxes, yield farming is probably not the best idea if you are worried about taxes as well, because you are doing a lot of transactions all over the place, which are almost all of those transactions are causing a taxable event. So it's a tax nightmare if you do all these yield farmings. So all in all, impermanent loss is a serious thing that you have to take into consideration. Do not provide liquidity on shitcoins. Always make sure that when you provide liquidity, that the project is legit. And if you provide liquidity, just know, and you can calculate it, that what is the potential impermanent loss that you can actually suffer, and are you okay for that impermanent loss to happen or not, if you want to suffer it or not. Anyway, that's pretty much all I have to say about impermanent loss. Hope you learned a little bit, and hope you can try to guard yourself against this impermanent loss. So for now, for example, what I'm currently doing, I do have auto in this auto to BNB pool, but on the way down here, I have actually bought more auto tokens that I have not provided liquidity with, because I'm expecting the price of auto to actually go back to $10,000 or even $20,000 in the future as well. So I'm currently been buying these auto tokens and waiting for the price to actually go up. We'll see if that actually happens, but I will be selling it at increments, but I'm not providing liquidity because I would be losing money to the impermanent loss again. So that's why I'm providing liquidity here, but I also have auto tokens in my wallet that I'm ready to sell, and I'm also accumulating these auto yield here that I'm currently actually this yield that I'm currently getting, I am selling this, but I have quite a bit of auto in my wallet that I'm currently just holding and waiting for the price to actually increase. So in case the price of auto actually goes down, I have stable coins once again ready while I'm currently selling this yield here that I'm getting every single day. Okay, I think that's everything I had to say about this topic. Hope you learned something. If you have questions about this, let me know in the comments. If you want to know more about auto farm or Binance Smart Chain farming, you can watch my previous videos. Anyway, that's it for this video. Hope you liked it. Consider subscribing, and I will see you on the next video.